Good evening, sir. Good evening, class. My name is Martina Richards.
And I'm Raquel Gilman.
Today we will be doing question number 7. What is reinvestment rate risk? Which has more reinvestment rate risk, a 1-year bond or a 10-year bond?
What is reinvestment rate risk? This is a risk in which the cash flow will have to be invested at lower rates in the future than the current rate being experienced. This becomes a major concern when existing investments are about to mature.
Which has more reinvestment rate risk, a 1-year bond or a 10-year bond? A 1-year bond has greater reinvestment rate risk than a 10-year bond. This is so because a 10-year bond will decrease the frequency at which cash becomes available and needs to be reinvested. For example, an investor buys a 10-year $100,000 bond with an interest rate of 6%. The investor expects to earn $6,000 per year from the security. However, at the end of the first year, interest rate falls to 4%.
Hence, if the investor buys another bond with the $6,000 received, they would receive only $240 annually rather than $360. Moreover, if interest rates subsequently increase and
they sell the bond before its maturity date, they stand to lose part of the principal.
Thank you, Martina and Raquel. Now we welcome Damali and Jake, who will give us their perspective on this question.
Hi, my name is Damali Brown, and I will be explaining what reinvestment risk is about. So reinvestment risk is a probability that the bond yield will change when the proceeds from a bond are reinvested, right? The shorter the life of a bond is the shorter the principal of the bond would need to be reinvested, and the higher the reinvestment risk will be.
Good night. Well, good day, everyone. My name is Jake. In terms of my part of the question is asked, which has more reinvestment rate risk, a 1-year bond or a 10-year bond? So in terms of answering that question now, the risk rate on a 10-year bond is significantly less than a 1-year bond because the coupon payments are significantly less than the principal amount. So the reinvestment rate risk on a 10-year bond is less than a 1-year bond. So in terms of understanding the reinvestment risk is the likelihood that an investment cash flow will earn less than in a new security or creating the opportunity cost. It is the potential that the investor will be unable to reinvest the cash flow at the rate comparable to their current rate of return. An example for this would be an investor who buys, using the same example, a 10-year 1,000 treasury note with the interest rate of 6%. The investor expects to earn $6,000 per year for the security. However, at the end of the first year, the interest rate falls to 4%. If the investor buys another bond with the $6,000 received, they would receive only $240 annually rather than $360. Moreover, if the interest rate subsequently increase and they sell the note before its maturity date, they stand to lost part of the principal.
All right, thank you, Damali and Jake. We now turn to Marisha and David, and they will give us a final perspective on the question.
Good evening, sir. This is the answer to question 7 on Unit 6 tutorial sheet valuation of bonds. Question 7 part A answer. The question goes, what is reinvestment rate risk? Reinvestment rate risk is defined as the risk that cash flows, interest plus principal repayments, will have to be reinvested in the future at rates lower than today's rate. David Darling will be giving the answer for the second part of the question.
Good evening. Tutorial sheet question 7. The second part of the question that states which has more reinvestment rate risk, a 1-year bond or a 10-year bond. First, rate risk on a 10-year bond is significantly less on a 1-year bond because the coupon payments are significantly less on the principal amount. So the reinvestment rate on a 10-year bond is less than on a 1-year bond. For example, if you have $500,000 and you invest that for 1 year, the interest of 10% would be $50,000 during the first year. After the first year, if you reinvest and the rate has fallen to 3%, you would have earned $50,000 on the first year and $15,000 on the second year. On the other hand, if you bought a 10-year at a 10%, it remains constant $50,000 per year. So clearly buying a bond that has a 10-year reinvestment rate is less, but the risk apply only to the coupon payments, not to the principal amount. Since the coupon payments are significantly less than the principal amount, the reinvestment rate on a long-term bond is significantly less than a short-term bond.
All right, thank you, Marisha and David. So just to wrap things up, we're looking at reinvestment rate risk, which has been appropriately or adequately defined as the risk that interest rates will fall and will be benefiting from lower rates in the future. Now, for a 10% coupon bond, it pays annual interest of $100, yeah. If this is a 10-year bond, then we won't have to worry about reinvesting our funds until 10 years down the road when the bond matures. At that point, we'll have to deal with whatever the rates are in the market. If rates are low, then we'll be earning a lower interest rate. If rates are higher, then we'll be earning higher interest rates. But we will not have to worry about that for 10 years. So our reinvestment rate risk is low. On the other hand, if this is a 1-year bond, then our reinvestment rate risk is high, simply because in 1 year, the bond will mature, we will get back our funds, and we will have to reinvest at whatever the rates are in a year. That means if rates are falling from 10%, in a year, we'll be earning a lower amount of interest annually. Alright, so all the best, guys. Keep pushing forward, and we'll be giving the next one soon.